The Federal Open Market Committee, now based in Washington, directs the Fed's most important instrument of monetary policy, the purchase and sale of government securities on the open market. To increase the supply of money and credit, that is, to inflate, the Fed buys government securities from a few hand-picked firms with newly created money. To tighten money and credit, the Fed sells securities. In this, it can act on its own discretion.
Every government wants the ability to create new money. Okay? It's an alternative to raising taxes. Taxes, as we said, when they're raised, tend to evoke a lot of resistance among the public. It's much less painless to increase the money supply. The effects, the negative effects, don't occur until 6 months, a year, 2 years later, at which time the increasing prices can be blamed on other factors, the weather, speculators, and so on.
Another device the Fed uses to control the amount of money in circulation is setting the discount rate. This is the interest rate charged to member banks when they borrow short-term from the so-called discount window. If the Fed lowers the discount rate for its loans, commercial banks will likely borrow more from the Fed. This increases the amount of funds banks have to lend. Bank credit thus becomes cheaper, as reflected in lower interest rates on bank loans and credit cards. The increase in funds available for banks to lend also increases the amount of money in the economy. The Fed can also manipulate the nation's money supply by raising or lowering the reserve requirement. Banks are required to set aside a percentage of their deposits as reserves to meet depositors' demands. When the Fed was established in 1913, it cut reserve requirements in half over the next 4 years, doubling the money supply by the end of World War I.